Hey, good morning, everybody. Welcome to the Quick Win Collective. Do not adjust your dials. It's not Jimmy Burgess, even though I play his stunt double from time to time down here in Florida. Jimmy is at our BHHS summit event right now. And so I said I would step in, and I'm really, really fortunate because we have a great episode for all of you today. And so, as Jimmy always says, drop in the chat where you're tuning in from. We've got thousands of people from across the country, and you're going to get two really great guests. We're going to start off with Justin Messer, who's the CEO of Prosperity Home Mortgage, going to talk a little about what happened over the last week as we've seen some economic news and the impact on mortgage rates. And then really the real thing I'm excited about is to have Lawrence Yun, the chief economist from the National Association of Realtors, is going to come on and give you a full forecast of everything that's happening right now in 2025 and preview into 2026 as well. And we were all going to come away a lot more informed and be able to have some great conversations with our clients out there because they always have questions about the economy and the impact on real estate, and we want to be that guide for them. And so welcome to the show. Appreciate you all being here today. And let's start off by welcoming Justin Messer from Prosperity.
Hey, good morning, Chris.
Hey, Justin, how are you? So we saw over the last week, we saw some jobs reports that came in pretty light. We saw massive jobs revision. We saw some inflationary data that's mixed. And I'm kind of curious, so much of this stuff has been kind of baked in already into the mortgage rates a little bit. I'm just curious what we've seen over the last week when we kind of look at mortgage rates and this economic news that's coming out and the thought on what it would or would not do to rates.
Yeah, the name of the game is volatility, and it seems like it's been that way, year to date 2025. To be honest with you, the most important thing is really what captures the news cycle, as I found. So yes, we have this push and pull between what I would call less than stellar jobs numbers. While we have kind of still stubbornly high inflation, a little bit above the Federal Reserve's target. So everything focuses very, very specifically around what is the Federal Reserve going to do? That seems to be the drumbeat of it. And as Lawrence, I'm sure, will point out, the Federal Reserve does not control the 30-year fixed mortgage rate. So they're kind of two independent things. Instead, that kind of marches to the drumbeat of the 10-year U.S. Treasury, which a lot of us know, which is just the rate at which the United States borrows money. So again, we want to keep our eyes on that 10-year Treasury rate. Now, listen, the inflation numbers came out, the jobs numbers came out, the 10-year Treasury reacted by dipping below 4% for the first time in recent memory, touched 3.99. As it kind of settled in and the news settled and people digested it, we're back up to like 4.05% today. Okay. So if we think about it, before the Fed makes their decision, which may or may not impact that 10-year Treasury, likely will have a little bit of a lowering effect, at least in the near term. We don't see huge amounts or opportunities for rates to drop. So if we're thinking about 4%, like outside of something really, really bad happening. So we're talking a significant slowdown in European and the Chinese economy, that sort of thing. We don't see dipping below 3.8%, right? Is it more likely that it hits 4.2% or 3.8%? We don't know. But that's not like a massive range when you're talking about making the decision to buy a house or sell a house, et cetera, in terms of how that's going to impact your outcome. The news cycle, though, I just saw a headline on CNBC, or maybe it was CNN, that said, hey, mortgage rates are dropping and they're dropping fast. Now, while that's true, it's not nearly at the rate that people would think, because if I'm just the average consumer sitting on the sideline taking a look at that, I think next stop 3%, we're back, baby, right? But in reality, we're talking about, hey, maybe we go from 6.5 to 6.25, which is fantastic and helps affordability, but it's not this huge material change that you would see from the headlines. And as we all know, we're all combating headlines with potential home buyers or potential home sellers.
Yeah, and I think that's the important part. And what I wanted to kind of ask you about too is that, so one, as we're out there having conversations with sellers or buyers, because it can impact both. Does a seller want to sell because of rates? Does a buyer want to get into the market because of rates? One of the things is this kind of fighting that misconception that something, that we're going to see four-handle, 30-year fixed rates here anytime soon. And again, unless we have catastrophe happen on some other front, that's not going to happen. And so we don't want people falsely sitting on the fence when they don't need to. But for some people that are impacting a little bit of those affordability challenges, because we've seen massive price appreciation over the last handful of years, there are some products out there, obviously, that can kind of help kind of be a gap filler on some of these rate fillers. And so I wanted to kind of have you talk a little bit about some of the optionality out there that sellers and buyers can kind of look at that when they're thinking about mortgage rates and, what they would need to be to feel comfortable to kind of get off the fence right now.
Yeah, one of the neat things is, we have a big network of, real estate professionals that we service and partner with. So we have a lot of folks on the listing side and a lot of folks on the buyer's agent side, and so that's kind of a push and pull for us sometimes too, because not always can there be everyone as a winner in these scenarios and these transactions. What I would say on the buyer side is, there are multiple tools to make them feel comfortable and get off the fence, but it all starts with education. So really, when we sit back about it, why do we want our mortgage interest rate to be in the 5%? Is it to, at the cocktail party, say I have a 5% rate, or is it a truly, is it, I would say, focused on actual affordability? Let's just say that. So one thing we like to talk about is, when the cost of capital decreases, meaning money gets cheaper, and it's all chasing the same thing, which is a limited housing supply, regardless of how you break it. Even if inventory floods on the market, we're still limited versus our demographic shifts. What happens to price? And again, absent some other externality that we're not thinking of, price will increase. So we have this wonderful chart that we love to show people because we have a ton of pre-approved buyers sitting on the sideline who've exited the market. And we like to say, hey, if you look at an average $700,000 sales price, so a little bit higher than some markets, a little bit lower than others, at a 6.75% interest rate, right? Today, that payment would be about $3,632. If rates drop to 5.75%, but home prices increase 10%, the payment on that same house is $3,594, and they've waited on the sideline for a year. They haven't paid down equity. Plus, I'm not a tax professional, but a little bit better write-off on 6.75% than 5.75%, which narrows that gap. So again, are you sitting on the sideline waiting for a 1% reduction in interest rates to then have a 10% increase in housing prices? And we all know on this call, most likely the outcome is we're in multiple bid offers. Things are going to happen. That price is going to drive up. You're not going to get the contingencies waived that you want. Maybe the home inspection isn't going to be addressed the way you want it. It's a much better time to buy right now. Still, that doesn't get some people off the market. Yeah. They say, hey, I want that 5.75%. In that case, I would just say, partner with somebody in your market who understands the game of buy downs, interest rate buy downs. So two very popular options would be one funded by the lender. So Prosperity would fund this one. And that's a 1-0 buy down. So all that means is for about 0.8% of the loan amount, we'll go ahead and fund that. And the borrower, where today's rate sheet price might be 6.5%, right? They'll pay 5.5% for the first year and then pay 6.5% thereafter. If their real outlook on the economy, and every buyer's outlook on the economy is rates are dropping precipitously and in the near future, they'll simply be able to refi out of that, especially if they partner with a lender who has a free refi opportunity for them, right? So that is that. From a seller's perspective, right? Some of the inventory, obviously, as we know, is kind of aging on market. And when we think about selling those, I think the knee-jerk reaction that we have in those tough conversations we have with sellers is, hey, we need to do a price reduction, right? And we like to think about that 3% price reduction range. And are there alternatives that benefit the seller much, much more? And if we look at it, actually offering a 2-1 interest rate buy down. So what that means is if rates are 6.5%, for the first year, the borrower will pay 4.5, and then 5.5 is a super enticing outcome. That also only costs the seller 2.3% of the loan amount. So if the buyer's putting down 20%, it's a little bit less than the 3% reduction that they would have. So it's a way to kind of incite excitement into the transaction, as well as offer a slightly lower seller concession versus the 3% that they would have in reduction. So again, education as the forefront to get buyers to kind of get off the fence around waiting is not really a positive outcome for them. 1% and a 10% change. And then again, those tools around 1% temporary buy downs and 2-1 temporary buy downs are huge tools in the belt to benefit both the buyer and again, motivating them, as well as the seller to save some money versus a straight price reduction, which also benefits the buyer in the near term. They'll save about, on a $500,000 house, they'll save over $9,000 versus just the straight price reduction. Again, it won't come with that equity, but it'd be cash flow savings over time.
Yeah, and I think what I really love about that is, beyond just for the buyer, but when you're focused on the seller, is because for a lot of us out there, we're dusting off some of those scripts that we've had and conversations about price reductions, because let's admit it, we went 3 or 4 years without ever having to talk about it. And so if you can bridge a conversation there with a seller that's not just a straight, hey, I think we should do a price reduction based on the feedback we're getting or the number of showings, whatever it may be, presenting them optionality, right? I think everyone feels comfortable when they have choices. So if you can talk to a seller and say, look, there's a couple options we have here. We can do the straight price reduction option, or there's this option as well too. I think it just gives a seller an opportunity to have some comfort in making a decision as of being told, I have to do this and there's no other option. So if anything, I think it makes those conversations a little bit easier to have as a real estate professional, because you're giving sellers optionality, which I think everybody just feels more comfortable when they have choices. So it's great. Justin, a lot to happen over the next couple months, I think, as well, too. And I know Lawrence is going to share some of that data as well. We'll have you back on. And next time you can sit with the real star Jimmy and not have to sit with, the B player here. But appreciate you taking some time to join us this morning, share what's going on. A lot happening in the news and the economics. But also good to know, too, that the dramatic of the headlines, like you noted, doesn't always translate into what we're actually seeing on the paper and in the numbers. A lot of these things we've already thought were coming, so they kind of get baked into the numbers before the headline hits. So great information, and appreciate taking some time to join us.
Thanks a lot for having me. All right. Thanks, everybody.
Thanks, Justin. All right. So the next guest that we have, Lawrence Yun, I think most of you have probably heard Lawrence. You've been live at an event that he's been at, heard him speak on maybe an event like this before, but I don't think there's anyone harder working in real estate than Lawrence Yun. Speaks to more agents, educates more agents on every single year to make sure that we are those knowledge leaders out in the marketplace. That's really, really important, that when we are talking to clients, we're bringing real information. That's what they're after. They can make better educated decisions the more educated that we are. And no one does that better than Lawrence. And so we're super excited to have the chief economist from the National Association of Realtors, Lawrence Yun, with us. Lawrence, good morning. Thanks for taking some time to join thousands of people from across the country that are tuning in. And very excited to hear the latest economic and real estate data that you have for us. And then we'll get into some questions after your presentation as well.
Thank you very much, Chris, for inviting me to share some thoughts with your top leading producers across the country. Certainly, Chris, you have been very involved relaying some important message related to the real estate market condition, as well as some policy recommendation that NAR could push for in Congress and elsewhere. So your input has been very grateful. And I always will mention, Jimmy Burgess, I met him in Florida at one of the local association function. And, we had a great conversation from it. And it's, we connected from it. He's from the panhandles of Florida. So I also relay whether or not he was aware that there is a director of a military base there named Dale Marks, who oversees the Air Force Base near Fort Walton area. Well, he got appointed as the Assistant Secretary of Defense, and he's currently working in the Pentagon, approved by the Senate. And one of the Berkshire Hathaway HomeServices Realtor is now providing advice on military housing matters. So we want to assure that our people who are serving our country is doing well. So I'm just very aware many of the realtors, agents of Berkshire Hathaway serving their community all across the country. So thank you for the invitation. And I guess I'll go into how I see the market developing. I don't want to be a wishful thinker. I want to apply logic to it. First, admittedly, this year has not really seen a recovery. And we did not have a good home sales activity in the past 2 years. So it's almost like 3 straight years of very difficult home sales market. Now, the clients, your past clients who purchased home 5 years ago, 3 years ago, 10 years ago, they are super happy with your service. They have built sizable housing wealth from the home purchase, which they had made. So they are very happy. But for people in the business of transaction, whether mortgage originators, the title insurance company, or even people who are involved in moving truck, it's been difficult. And certainly for the realtors, when I look at the aggregate number, the numbers have been running a little low. But the question is, now with the mortgage rate beginning to dip down, next week, the Federal Reserve will definitely be cutting interest rates for sure. 99.9% chance, according to the Wall Street expectations, and probably more rate cuts. So we are now moving into a downward cycle in interest rate environment. And how will this begin to change some of the home buying activity? Let me put it onto the screen and go from there. So my presentation will be roughly 25, 30 minutes long. Then afterwards, I will be happy to go into Q&A with Chris Kelly. So let me go into the slides. And the first slide is the following. So this is the Federal Reserve interest rate policy. As Justin mentioned, this is not the mortgage rate, and mortgage rate do not follow one-to-one with the Federal Reserve official policy. One can view this as essentially the lending rate for the banking system. So sometimes it goes up, sometimes it goes down. But interesting part is the last red arrow that you see. That is the most aggressive hiking of the interest rate in 2 generations. I mean, we have not seen anything like that in the U.S. history until about 1980s period. So very, very aggressive raising of the interest rate, which essentially flipped the housing market. Flipping in a sense that prior to the interest rate hike, we saw frenzy home buying activity, multiple offer situation. We didn't even have time to breathe. Just so much multiple offer, prices rising so fast. Then home sales came down once the interest rate went up, and it's been stagnant for the past 2.5 year condition because of this aggressive policy. Now, what did it do to the mortgage rates? So the blue line is the same blue line the Federal Reserve control. I shortened the timeline to sort of look at the figure a little carefully. The red line is what you care about, the average 30-year fixed rate mortgage. So as you can see from the beginning of the chart, which was 3-4% mortgage rate, then it climbed up to 8%. The red line going up to 8%, then sort of staying at near 7%. And in fact, it's been 7% average rate in the first half of this year. But this week, we are seeing mortgage rate going towards 6.3% average. So it is not a big decline, but still a meaningful decline condition. Now, it's not the 3%, 4% of what it had been, say, early part of this graph that you see. And I don't anticipate we will get to the 3%, 4%, or even 5% mortgage rate, even with a Federal Reserve rate cut. But when we did some analysis, even a 6% mortgage rate will begin to revive some of the home sales activity, the pent-up demand that has been developing. People who are very technically minded, I also included the green line, which is the 10-year Treasury yield, because mortgage rate would generally follow the 10-year Treasury yield much more closely rather than the blue line, which is the Federal Reserve policy. But as you can see, I put that little blue arrow at the end to imply that expect Federal Reserve to cut interest rate next week, then probably 1 or 2 more times before the year finishes. And then I think there's going to be another 3, 4, 5 rounds of rate cut in 2026. So we are moving away from high interest rate environment to normalization. Normalization, getting back to historical average condition just means that Federal Reserve would need to make cumulatively 6, 7, or 8 rounds of rate cut. So when will the Federal Reserve consistently look towards cutting interest rate? Well, the Federal Reserve has 2 jobs. First job is to contain inflation. You want to make sure that the dollar has purchasing power. We don't want to be Venezuela, or we don't want to be, what happened to the many Eastern European economies once the Soviet Union collapsed. All their savings disappeared because of hyperinflation. So we want to make sure dollar is a dollar. So you want to contain inflation. What does containing inflation mean? It means trying to get the inflation at under 2%, under the red line. Right now, inflation is still above that. Its most recent data came out this week, showing 2.9% higher prices compared to 1 year ago. So we are not really contained in terms of inflation, yet we are close to that. I mean, essentially a decimal point. Elementary school kids will say 2%, 2.9%. Those are the same figures. Why doesn't the Federal Reserve cut interest rate already? So Federal Reserve has been a little cautious about cutting interest rate. Certainly, as many of you are aware, there's been a huge debate in Washington. My office is in Washington. Today, I'm visiting one of the mid-sized town in Virginia. So I'm in a hotel room in Virginia. Giving this webinar. I guess that's part of the virtual world now. One can travel across the country virtually quickly. But in Washington, the big debate is White House wanted the interest rate cut several months ago, deeper cuts, while the Federal Reserve has been hesitant, not wanting to cut interest rate because they are saying, look at this figure. We are not at the 2% target rate yet. Second goal of the Federal Reserve is make sure that the job market is healthy. So even though inflation is not fully under control, we have seen some deterioration in the labor market, a little wobble in the labor market. And I think the focus is away from this figure and more towards the wobbly job market. And consequently, there will be a rate cut next week. And again, more rounds of rate cut. And anytime economy weakens, there's generally less inflationary pressure down the line. Federal Reserve has indicated they're concerned about tariff impact on inflation, but President Trump retorts, look, I have a deep regulatory policy. Anytime there's less regulation, it lowers business opportunity costs. And also, gasoline prices have come down to pre-COVID levels. We know that the realtors drive much more than the average population, so lower gasoline prices certainly helps realtors. But let's consider 18-wheeler trucks carrying those, say, Chinese toys for Christmas delivery, Christmas presents. Well, the tariff will make it more expensive, but the delivery of those toys across the country, 18-wheelers, is much cheaper now. So, there's some inflationary pressure, but also disinflationary pressure playing at the same time. But the latest figure is saying we are not fully contained, but maybe we will soon reach the 2% target rate before the year end. And if the Federal Reserve is convinced of that, they will be much more inclined to be a little more aggressive in cutting interest rate. So rather than trying to express people's view about how many cuts should the Federal Reserve do, just like you make a bet on NFL games, the Dallas Cowboys, Green Bay Packers, whomever you want to choose. Some people say, oh, my team will win. Well, put your money where your mouth is. Are you willing to make a bet to say your team will win? So if we look at the economy, there's a bettor's market. People who bet money regarding how many rate cut by the Federal Reserve. And what the bettor's market is indicating is that right now, people believe there will be 3 rate cuts this year. Some believing there will be 2 rate cuts, essentially either 2 or 3. That's the dominant answer. In fact, this graph just changed this week. Even last week, more people said 2 rate cut and not 3. But this week, people are betting money are indicating 3 rate cuts this year. Now, if we were to play out for 2026, there will be even more rate cut in 2026. But people who are putting dollars into their opinion are expressing 3 rate cuts for this year. So let's look at the job market. So inflation is almost contained, but not fully. Job market becoming wobbly. What does that wobble mean? Well, certainly this graph does not show any wobble because we have highest number of people with job in America. The graph begins from pre-COVID. Then you see the COVID disruption where people lost jobs. But once the economy reopened, more job, such that today we have 7 million more jobs compared to pre-COVID highs. Record high number of jobs. There was a data revision indicating maybe we have 1 million fewer jobs than what is shown here. But even with the data revision, maybe it's now 6 million more jobs rather than 7 million. But the trend line is we have record high number of jobs even after accounting for the revision. So if we have record high number of jobs, certainly home sales should be doing better than pre-COVID. But we know home sales are much below pre-COVID condition. So we have jobs, but home sales down, which means there's a mismatch. What is the reason for the mismatch? Well, we know mortgage rates are very, very important. So this elevated mortgage rate, which we have been encountering for the past couple of years, it certainly has held back. But think about what would happen to potential home buying once the mortgage rate begins to go down. Is it going to open up the gate so that more people you see on the graph with job begins to enter the housing market as the mortgage rate goes down? So job market condition record high. So where is the wobble? The same graph, I'm going to put it in a different form. So this is how many job addition each month. So rather than the total number of people with job, so let me just, as a reminder, how many people have job? This is this graph. How many job addition each month? And it is this graph. So as you can see, the job addition each month has been much softer now than before. And this is the concern that the Federal Reserve has. And furthermore, Federal Reserve has two mandates: contain inflation, and also the job market is healthy. And they're looking at the job market and they're saying, no, maybe the job market needs a little stimulus, a little boost to it. So maybe cutting interest rate could stimulate some of the job gains condition. I also want to mention that we know that early part of the year, Elon Musk came to Washington and he said, look, there's too much bureaucracy, too many unnecessary workers. So they slashed federal government employees. So he has fallen by roughly 100,000 so far. Is anticipated to decline a little further. So some of the softness in the job addition is due to the fact that, well, federal government is reducing its size. Is it good? Is it bad? But, that the reality of softer job market is partly driven by the fact that reduction in some of the federal government employees. I'm from the DC area. I see it much more visibly. But when I speak with, say, a realtor in Atlanta, they're also indicating there's job cut at Center for Disease Control. So the other parts of the country may also be seeing some impact of this. But the DC area is the clear ground zero impact of the reduction in the federal government size from this. So naturally, the job market will not be as strong if there is a job cut in one of the sectors of the economy. Now, with jobs, is it a high-paying job, low-paying jobs that we are adding to the economy? And what we are finding is that the typical jobs are about the middle income. So there are some high income job creation, some low income job creation, but on average, it's about middle. So no real big shift in one way or the other. And I don't anticipate to see that on a month-to-month figures. Maybe over a long period, we may begin to sense whether or not it's high-paying job or low-paying job. But in the meantime, the month-to-month data is indicating Americans are finding jobs, even at a slower pace of job creation, with improvement in standard of living. The red line shows the wage growth of a typical worker, while the blue line is the consumer price inflation. So the first half of the graph is showing that Americans were very angry when inflation was high because whatever they were earning, it was getting burned at the gas station, it was getting taken out at the grocery store, and their standard of living was falling. But as you can see on the second half of the chart, the red line is above the blue, hence standard of living rising modestly. Or in the real world impact, you may say, on average, consumers have little extra money to save up for down payment if they want to buy that next home. So wages outpacing consumer price inflation. So a little positive sign there. We just want the job creation to strengthen. But federal government slashing jobs, so there's also that impact as well. Let's look across the country. Which area is seeing strong job growth and comparison? So if you're in the green color state, congratulations, you are in a superstar job creating state. Very fast job creation. For example, in the state of Texas, 11.0, 11% more people working in Texas compared to pre-COVID highs. Before the arrival of the ugly virus, essentially every state was doing very well. So I'm comparing with pre-COVID highs with the most recently available, and Texas added 11%, Utah so doing very well. Idaho doing very well. Carolinas, Florida. Dark blue, essentially above national average. Light blue, you are adding jobs. So job addition is a good thing, but little sluggish, one step behind in terms of adding job condition. So essentially, you see throughout the country, we are adding job, increasing potential housing demand. When we will see actual realization of that housing demand. And in my view, we need more inventory and we need lower interest rate. Inventory, we are getting that right now. We have more inventory in the market. We just need a little lower mortgage rate, and at least it is trending in the right direction with a more rate cut anticipation. I think the mortgage rate, it's not a one-to-one relationship, but in anticipation of the Federal Reserve cuts, the mortgage rate or the 10-year Treasury yesterday reached 4%. That is one of the lowest in the past 12 months. So the mortgage rate already reaching about 1-year low level condition. So let's look at the real estate market and how it has fared. So annual home sales, beginning from 2019 pre-COVID. If you look at 2018, 2017, years before COVID, it looked just like 2019. So you can't even say that 2019 was essentially normal housing year in terms of home sales activity. Then we were hit with COVID, but also lower interest rate environment. So home sales got boosted in the 2 years once the COVID came. But once the Federal Reserve aggressively raised interest rates, you see the sales coming down, sales coming down. Difficult condition in 2023, same as in 2024. What about 2025? Well, 2025, when we look at the monthly data, we have not seen any recovery so far on a nationwide basis. I will admit, I had been wrong in my forecast for 2025. I thought we would see a robust spring home buying season in 2025. It did not happen. But I was basing on the assumption that the mortgage rate would be a little better, but mortgage rate refused to go down in spring. So it is highly dependent on the mortgage rate condition. So first half of the year, elevated mortgage rate, refusing to help on the home sales market. So far this year, again, trending very, very low in terms of home sales. But we know that the job numbers are record high, especially in those superstar states of the green color where job creation has been very solid. So one wonders when those job holders will begin to reach the housing market once the mortgage rate goes down. I recently did this analysis. So this is saying that in a neighborhood with 1,000 residents, 1,000 residents, so you can visualize the neighborhood that you specialize in, about 1,000 people. How many home sales are there? And it shows over time that sometimes it could be 20 home sales, maybe other years it could be 25 home sales. But look what has been in recently. Only 14 home sales for 1,000 residents. This is not a good reflection of America because in America, we want dynamism. Anytime there's a sellable home and purchase of a home, I consider that probably an improvement in financial circumstances, either trading up, maybe retirees looking for better lifestyle, maybe they are looking for smaller size, using housing equity for their retirement years. But anytime people buy a home and sell home, this is all good dynamics. But as you can see, we have not had that dynamism. But lack of that dynamism is simply reflection of high interest rates. So as mortgage rate goes down, maybe we will soon re-encounter more dynamism in America, something we definitely need. And the inventory situation, now it is climbing out. As you can see, we're not back to pre-COVID nationwide basis. I know in the Florida condo market, special unique circumstances, huge inventory, prices coming down on the condo market in Florida. Also in state of Texas, where there has been an active new home construction over the past 5 years. Now that is showing up as excess supply. So you are seeing some price decline, say in Austin, Texas, Dallas. But given job growth, I would consider any price decline as a temporary decline, second chance opportunity to get into the market. If you remember a couple of years ago, because of the lower interest rate environment of 3%, 4%. People bought home at that interest rate or people refinance. They were never going to give that up. They were never going to sell their home. Well, what do you know? We are seeing more inventory because even as some people are locked in, there's major life-changing events suddenly appearing. Maybe additional child in the family. People need larger size home. Maybe there is a death in the family. Sons and daughters inherit the property. What do? They don't know. Just put it on the market. Maybe there's a new job at different areas. So the commuting is impossible. So they need to move to different residence. Every year, life-changing events occur, divorces, marriages, life-changing events constantly accumulate, so it's being reflected. So the illustration of this is the worst shortage in inventory is over. So expect more inventory to show up on the market. I know the many realtors already are a little busier physically. They're putting that for sale sign up in the front yard. So more busier. We just need more buyers to begin to match the rising demand. And also, if you look at the high inventory level back in 2010, that's when we had the implosion in that risky mortgages, subprime loan, and it imploded. There were no buyers, job losses, massive, price decline, significant foreclosure crisis. One other thing that we heard from the realtors across the country, including from Chris, was that can we do something to stimulate the housing market back then? And one thing that was consensus was that, well, let's put a home buyer tax credit at that time, essentially to say you buy a home and you get $8,000. So there was a temporary home buyer tax credit. And even in a recession, 60%, 70% of Americans believe they have a secure job and they respond to those incentives, and that began to bring down the inventory condition. In the current environment, you see that inventory is beginning to rise. So it's not about trying to additionally juice up the market with home buyer tax credit, but what we are looking for is different type of policy, which I will soon go into. We heard from the realtors across the country, and thanks for everyone who participate at the state, local association, or are involved at the NAR level, giving us the information as to what needs to be done. So going into your consumers. Home sales has been difficult, but your consumers, past clients are all smiling because they're seeing this housing wealth condition. How much price appreciation over the past 5 years? Every state is doing well. Let's choose Iowa, for example, see if you can identify Iowa. 42%. They're a little lagging behind other states, but even 42% price gain in 5 years, these are significant gains. So given so much price appreciation, what we are beginning to see is that if some homeowner wants to sell their home, they are getting ensnared in the capital gains tax. Because you told your clients in the past, buy a home, you get mortgage interest deduction, and when you sell your home, that profit is all yours. Well, because of such a strong price appreciation, we are beginning to see more and more people needing to pay capital gains tax if they sell their home. So out of fairness, we are asking Congress essentially to say, can you lift that amount? And if there was an indexation with consumer price inflation, just like Social Security check is indexed to consumer price inflation, the current exemption amount would be double of what it is. So rather than $250,000 for single, it would be $500,000. So rather than $500,000 for, say, married couple selling their home capital gains exemption, it could be $1 million. So we are working with Congress. There's actual legislation. We just are looking for the right vehicle to include it in it. But that's certainly one of the priorities. We heard from the realtors across the country on needing to do that. And also, for some of the property tax deduction, at least we got that included so that now people living in New Jersey and other places, they can fully deduct property tax rather than be limited on that. So thank you for your participation in all the discussion on NAR policy. And I will have to give a little credit to our advocacy team. Amazing thing. Did you know there was a real estate caucus? So there was a group of members of Congress who have certain interests. So he started with 4 members of Congress. I think maybe 2 were actual realtors who are members of Congress, 1 appraisals. But today we have over 100 people who are part of the real estate caucus, which means they're focused on real estate, where can easily communicate. So the number is rising. So when we are looking at some real estate issue, we will be looking to make sure that homeowners, we want to protect private property rights, but also anything real estate. Healthy real estate is good for America. Healthy real estate is good for the economy, passing on those messages. So let's move on. So because of the price increase, this is the real estate wealth for the country, all-time high. Stock market, all-time high. So anyone with exposure to ownership, whether ownership in stocks, ownership in real estate, doing very, very well in America. But we have a divided society. Renters feel left out. They're not participating in real estate wealth. So home ownership opportunity for more Americans, very, very important so they can participate in real estate wealth condition. So you see this, but is the real estate wealth on a solid footing, or is it wobbly? Could it crash? And this is the chart that shows that real estate wealth is on solid footing. If you look at 2010, we had a blow up in those bad mortgages, increase in delinquency, increase in foreclosures. What do we see today? Well, we have low delinquency and low foreclosure rate. Even in a good economy, we know there are certain individuals who will encounter some financial difficulties, so there will always be some degree of foreclosures. But historically speaking, we are at historically low level, indicating that we are on a solid footing, and thank goodness that we don't have those funny, risky mortgages anymore. And I like the idea of the mortgage rate buy down, because when people are looking at buying a home, certainly their monthly payment matters a lot. But as the interest rate movement is now beginning to go down, certainly any adjustment in future rates will probably at the lower rate condition. But people have to meet that credit standard before getting a mortgage. Back in 2010, your uncle, who you refused to lend even $20 to, that bothering uncle said, hey, can you lend me $20? And you would definitely not lend $20 to him. Well, he could get a mortgage to buy a home. And of course, it blew up. So we want to make sure people who take out a mortgage, they are on solid credit footing. And that's where we are. And consequently, we are at lower foreclosure rate condition. And furthermore, we have quite a substantially high people with free and clear home ownership, no mortgages, zero chance of a foreclosure. So this is also another indication home values are on solid footing. Any price decline in some market should be viewed as temporary second chance opportunity to get into the market. And I'm down to my final two slides. This is a mortgage application to buy a home, changed from 1 year ago. When people apply for mortgage, it's not just clicking a button. They have to fill out the form. They have to reveal some sensitive financial information. This is a serious intent of going to, wanting to buy a home. Now, do people actually get a mortgage after application? No, this is just application, not an approval. Maybe some people got denied. Also, even if after people got approved, they said, well, I did not find the right inventory. Or maybe they think maybe mortgage rate is a little too high, they're stretching their budget. But once the mortgage rate comes down, you can anticipate the serious intent, which has been positive, beginning to translate into actual closings. Even those people who got rejected in mortgage applications, say in the springtime, they have a better chance of getting approval now because the monthly payment situation in relation to their income will be improving with a lower interest rate. So serious intent, very good. And my final slide as to what you can anticipate. Now, there's no guarantee that I will be right or not. I'm just applying my computer model, trying to apply logic to it. I'll look at the income distribution across the country. What happens if the mortgage rate declines a certain way? So we apply a logic. So in 2025, one can say is a bummer because we did not see any recovery first half of the year. But I think the fourth quarter will be better compared to fourth quarter of last year. It's a slight increase. But next year, while the sales that did not happen this year is simply getting pushed over to next year. As to the new home construction sales, it depends on building activity. So more building will lead to some growth in the new home sales. And prices nationwide don't expect any kind of spike nor any crash. Maybe some market will see, a single-digit price decline temporarily, but nationwide, prices look to be on the solid ground. And we know that home ownership build wealth over time. In some years, more modest, other years more strongly. But this is clearly implying that with the mortgage rate anticipated to go to 6% rate, not 5%. I think 5% is a little stretch given we have a huge national debt. So government borrowing naturally will prevent the mortgage rate from going down to large decline. So I would say 6%, 5.8%, 6.2% as the more new normal condition for most of 2026. So with this, be prepared for improvement in your business and best to you. And now, happy to turn it back over to Chris.
Lawrence, thank you. That was incredible. And to address some of the first questions out of it, as a reminder, all of these sessions are recorded. They're on the YouTube channel, so you can go there and check any of them out. And then Lawrence, a lot of folks asking if we can get the slides. If you want to email them to me, I'm happy to make sure they get out to everybody who tuned in today.
Most certainly.
So a couple questions. I was kind of monitoring the chat as we were going through it and want to throw some questions out there a little bit too. One of the things that we kept hearing over the last handful of years was like, there's a recession coming, right? It's like been the most predicted thing that's not happened yet. As you kind of look at the broader economy and real estate, certainly real estate's been in a recession. If you just look at, year over year sales and everything else like that, the broader economy, what do you see out there? Because I guess that's one thing. Economic conditions could improve for real estate from mortgage rates and affordability. But if other things are offset in a broader economic downturn, maybe those things get washed out. What do you kind of see on the broader economy from the recessionary risk that we face over the next couple of years?
No, there was an increased discussion among economists of the recession possibilities, or people are raising their forecast of say 20% recession chance now to 40% recession chance and things like this. And most of it is related to tariffs, how that could disrupt some of the supply chain reaction on all the production factors part. But I would put it the following. We are at a record high stock market. I don't know whether it's going to hold on or not, but that is a huge financial resource for companies to expand factory production, hire more people into the future. We know that the homeowners, 66% of the population, they are sitting comfortably, so that their consumer spending aspect is still very solid. Maybe the renters are overstretched, maybe young adults with student debts, they're holding back some degree. So at least if you look at the wealth effect to the economy, it's implying no recession. Now, let's hypothetically say we do encounter a recession, which means job loss situation. When I look at past economic recession, this is what I found. You exclude that subprime loan blow up in 2010. That was a special, unique, we hope never to repeat situation. Mortgage blew up and caused the Great Recession. But if we look at year 2000 recession, year 1990 recession, year 1981 recession, every time we look at those recession, what happened was that home sales actually increased. And you say, how is that when there is because over 90% of the people have jobs and about 60% or so have very secure job, and they're just looking at mortgage rate. So if there is a recession, generally one can anticipate lower interest rate, Federal Reserve cutting interest rate deeper, and consequently, the housing sector begins to bring the economy out of the recession as more people buy a home, home builders get more active.
Yeah, and I think that's just good, helpful information to everybody that, again, it's amazing, and maybe it's just part of the social media world that we live in, the doomsdayers, right? And again, we're not wanting to look at the real estate market through, in a Pollyannish way or through rose-colored glasses. We want to look at it in a very honest and truthful way. One of the things I like that you really showed on many of your charts is you historically go back to the 90s, to the 80s if necessary, because a lot of what we see out right now is say, look what's happened over the last couple of years to try to paint something terrible that's coming for a housing crash. And when you historically look back, inventory is one of those things to look at. We're still not back to what we would call normalized inventory levels, climbing, but historically speaking, we've had more inventory on the market at points in the 80s and the 70s.
When we look at the population growth in the U.S., how many new homes were constructed to sort of match up with those population growth. I mean, it's not that, the people who are coming to the country or the birth of a family leads to new home construction purchase. It's more like trading up, existing homeowners trade up to the new home, and that brings, and all this. So when we did the calculation, we estimated about 4 to 5 million housing unit shortage, not enough housing in relation to the population growth. Freddie Mac estimated at, I think, more like 3 million housing shortage. Home builders estimated at 2 million. So people have different estimates, but clearly there is a housing shortage, which is the reason why there is a bipartisan Senate bill currently. I think it was, believe it or not, it's a joint sponsorship by Tim Scott, South Carolina Senator, Republican, and jointly with Elizabeth Warren, a Massachusetts Senator, to say that we have a housing shortage. Maybe we don't feel it at the moment because of high interest rate, but once interest rate goes down, that housing shortage will quickly appear. So we want to make sure that more homes can be built across the country. President Trump has even touted that maybe opening up some land in the western states, public land for home building activity. So anything to boost supply, because once interest rate normalize, we don't want just demand to be there. We want the supply to be there as well, so that any overburdensome regulation that prevents supply from reaching, well, we want to remove those barriers.
Yeah, and that ties in with a topic you brought up that really it started some chatter in the chat room, and that is over the capital gains cap and how that could potentially free up some inventory as well. And it's great to hear the bipartisan support around that. I know there's a little bit of you've got people on one side of the aisle say, wow, this is, for a tax, this would just be a tax cut for the rich. And then you have the other aisle that says, wow, this is really just going to benefit blue state people. Well, let's just look at us all as American homeowners as we try to benefit this. But one of the things that I saw most recently was that, roughly, 15 to 20% of American homeowners right now would be impacted by that cap. They would, meaning if they sold their house right now, their proceeds would exceed the 250 as a single, 500 as a married couple. But over the next 5 to 7 years, that number could double. And especially states like California and New York, where you've already had Florida now with a higher price appreciation as well, too. So you could have some areas where 30, 40% of the people that when they went to sell their home would be impacted by that. We think there's a rate lock-in effect because of mortgage rates, people having a 3% mortgage. When you start seeing capital gains on there, there's real evidence of folks saying, it might be cheaper for me just to hold on to this house and have it transfer at death as opposed to sell it now and pay taxes on it. And so from an existing home inventory, that cap has a real impact. And it's great to hear that you and the team at the National Association are dedicating resources to help get that moved.
Yeah, absolutely. It's just out of the fairness, because we know the price of our hamburger has risen, price of everything has risen. Why hasn't the cap limit, which was set back in 1997, it has not changed since then, almost 30 years, just indexed to inflation. And then we have the original intent, essentially to say homeowners, you sell your home, the profit is all yours. And most people do not view it as pure profit, but just advancement in their life, to say, I'm going to use the proceeds for next down payment and so forth. It's certainly that original intent. Homeowners should not face the capital gains tax. Well, that was the original intent. Today, more people getting caught in that. So lifting it certainly makes logical sense.
Yeah, we know that home ownership is the single largest driver of wealth creation for U.S. homeowners and for all U.S. citizens. We don't want to do anything that deters that or takes away the power that the housing has had in creating wealth for generations. The other thing that I'm curious about a little bit on the regulatory side, having lived in Texas for a number of years before now and stuff, was that the impact of property taxes. And I'm kind of curious your thought on, where we're seeing that impact on housing a little bit too, with rising, because we've seen so much price appreciation over the last 5 years. Property taxes have really kind of accelerated too, to where you have people that they might own their home free and clear, or they may have a very low mortgage, but the property taxes now have doubled or even gone up more than that over the last 5 or 6 years. What are you seeing from an impact on that with real estate taxes and from a regulatory perspective at NAR as well?
States where there is a zero state income tax, like Tennessee, Texas, big draw of new residents wanting to move into where states have a zero state income tax. But how do you fund it? Well, part of it is through a property tax. So in Texas, property tax tends to be a little higher compared to the rest of the country, even though there is a zero state income tax. Now, with the property values being much higher, some local communities are saying maybe, given incomes are rising at only 3%, why is it that property tax should suddenly rise 10%? Or say you combine typical inflation of say 2-3%, population growth in Texas of say 2-3%. Well, certainly you don't need more than combination of that, which is about 5% increase in tax revenue. So why is the property tax rising even beyond that? But I think those are something that the realtors can engage with the local state legislature explaining the figure. And of course, I think the most important part once to demonstrate is healthy real estate is good for the state economy. One clearly sees that throughout the country where the real estate is healthy, it's good for the community. Home ownership opportunities better where the real estate is healthier. And in some cities, one thing that Californians have consistently argued with their state legislature is we're not building it up. And one of the consequence of that is you have super expensive homes in, say, San Francisco, but the home ownership rate is very, very low, which means that few people are getting huge wealth, while majority of the people are not getting any wealth due to the lack of home ownership opportunity. So those are sort of the trade-off, I think, at the state level, local level, people are always discussing. Another part, insurance. Insurance is essentially a state level discussion, and we hear from realtors constantly. What can NAR do about insurance situation? Flood insurance, because it's a national program, we want to make sure that's available or any increase in premium is reasonable and manageable. But at the property insurance, those are state regulated issue. So the realtors have to be involved not only at the national policy, but at the state policy as well.
Yeah, a couple of people commenting that, there's discussion in Florida about eliminating the real estate taxes, and they already don't have an state income tax too. So where does the money come from? And I guess it's everyone visiting Disney World, right? So yeah, there's lots of the money has to come from somewhere, but it is a confounding issue right now. And I'm glad you raised the insurance issue too, because again, think about insurance. It covers the value of the property. If the property values have gone up as much as we saw from your chart over the last 5 years, we're seeing that impact our insurance rates as well. The one on your last slide, what I wanted to note, because when you were talking about projected rate cuts, a couple people started kind of, well, how many in 26 and what does that mean at the end of 26, 27? From everything that I've seen you all put out, from what I've seen Fannie Mae put out, really, as we look over the next, 12 to 24 months, and they are projections, as you noted, right? We're guessing here based on current data and information. No one's projecting anything, that the first number of mortgage rates of the 30-year fixed being anything less than a 6. So whether that's 6%, 6.1, maybe it's 5.9, but no one's really anticipating, even with multiple rate cuts this year and maybe a few more next year, of again, that dramatic change in interest rates. And so that's really important for us to educate our clients about that. Some of this, there's the spread between the 10-year yield and the 30-year fixed. That's a risk rate that could expand and contract. That has an impact as well. But if you could just touch on a little bit as we kind of wrap things up here too, about as you're talking with buyers and sellers, again, unless we have another pandemic or maybe a major war, we're not going to likely see a 4% mortgage or 3% mortgage. And that's okay. It's okay. Like a normalized, non-volatile rates, rate spread is actually probably a pretty good thing as we move forward into the future.
Yeah, the bond market, 10-year treasury, 30-year fixed rate mortgage is all in anticipation of a variety of factors. And Federal Reserve rate cut is just one of them, which is the reason why, even as the Fed has not done any rate cut, mortgage rate have come down in the past 2 weeks in anticipation. But once it cuts, it may not move all that much. So people who are waiting for the date of the Federal Reserve cut, they could be completely disappointed part. So people need to be aware of that. But the other part is, think about who are lending it for 10 years or 30 years. If there is a high inflation, well, the money one is getting back would have lost value after 10 years. So they said, why did I lend the money? So only way to compensate for higher inflation is to charge higher interest rate. So inflation expectation also plays into the reason why mortgage rate is unlikely to go to 4% or even 5%. And the federal budget deficit, we know it is rising. It rose tremendously over I would say, the past 12 years. So it's not any one presidency, it's just been rising consistently. Maybe it's part of the outcome of the democracy. We see in France, their debt levels are just flipping over into huge amount. But large federal budget deficit simply means government has to borrow. So they are borrowing the capital that could have gone to the mortgage market, and it's being reflected in terms of 6% mortgage rate rather than 5% mortgage rate.
Yeah. Well, Lawrence, again, we so appreciate your time coming on and sharing some incredible information that we can now take to, again, kind of give out to our clients. Again, an educated client is a good client. It means they make more informed decisions. They're happier with their decisions. They make better real estate decisions. And that's really what all of us do, is really kind of help guide them on that. And you are a tremendous teacher and educator, and we appreciate all that you do on behalf of our broader real estate community and everything you do on behalf of the industry. So appreciate the time. I know that you probably have 4 more of these to do throughout the rest of today, live and virtual. And so the fact that you gave us a full hour is we're beyond grateful. So really, really appreciate it.
I enjoyed it. Thank you very much for having me.
Thank you, Lawrence. And everybody, thanks for tuning in today. Make sure you tune in next week, or Jimmy will never allow me to guest host for him ever again. We'll have another great episode next Friday when he is back. So thanks for tuning in and listening in to Lawrence. What a great treat we had, and some good information. And again, you can find the recording on the YouTube side, and then we'll also get the slides out to everybody who registered today. And feel free to share it with all of your peers in your offices as well once you get those slides. Thanks a lot. Have a great weekend.